it's war. President Trump lives up to a key campaign promise, and Wall Street goes into panic mode as the Dow gets slammed 724 points. The globalists hate change to the status quo, even if it means China ripping off our best fighter jets and smartest computer technology. The market also not too happy with the big change in President Trump's legal team, as any signs of or hints of a constitutional crisis trigger sell programs. And then, of course, there's the Fed, which many mavens now believe is ready to derail this economic recovery. But the Wall Street to Washington axis should actually be thrilled with the spending bill, because that has no guardrails. It's like $1.3 trillion. Everyone's happy with that. Of course, though, we have to start with the sell-off with the stock market. Joining me now, Erin Gibbs, S&P Equity Chief Investment Officer, Jim Awad, Hartland & Company Senior Managing Director, and Danielle DiMartino Booth, former Dallas Fed advisor and current president of Money Strong. Danielle, I'll start with you, because the down pressure on the market began before the open, when all of a sudden the consensus was that the Fed is hawkish. They're going to raise rates 4 times. And I didn't sense that yesterday. What did you sense?
I actually did. He said that he was thinking about 8 press conferences a year. I mean, please, let's be grown up about this. But that's going to give the Fed more flexibility and potentially the ability to raise rates 8 times a year instead of the 4 that they're blocked into.
They have changed rates without press conferences. They've lowered and increased them. No?
Not in years. The emergency measures that they took were on a downward path, and that was during the crisis. So it's been well over a decade, Charles.
Okay, listen, I'm a big boxing fan, except when it goes to the scorecards, right? That's when it gets a little murky, especially if it's one of my favorite promoters. And you always wonder, what the hell are these judges watching? How come this so-called dot plot is so all over the place, Danielle? You got 6 people looking for a rate, 4 rate hikes, 6 looking for 3 rate hikes, 1 person out of their mind looking for 5 rate hikes, and 2, the dovish guys looking for just 2. How can all of these so-called experts be so far apart?
Well, I think that Powell actually spoke to it yesterday. He hinted that the dot plot was kind of useless. And it really is, because as he said, we made the decision at this one meeting to raise interest rates. We will be data dependent at every single meeting. He dissed the dot plots. So you're right there with him and the way he's thinking, that it's useless and that it creates confusion unnecessarily.
And that brings me back, Erin, to the idea, then why did we sell off if the Fed right now is just suggesting from their data a Goldilocks scenario? They increased GDP, they lowered unemployment, but they saw no change in inflation. To me, that's the ultimate growth scenario.
And I think ultimately it was very positive. And for most part of the day, after 2 and 2:30, the markets were pretty stable. I really see today's change. It was down. The market sort of retraced. It was really after that 12:30 announcement that the market really started to tumble. So for me, this seems more like a reaction to the trade war rather than the Fed rate hikes.
I'm going to get back to you on that, but Jim, I want to get back to circle back, okay, because we got the trade war, we got changes in Trump's team, you've got this budget buster, which, listen, the markets do react to our trade deficit, or to our deficit, which is $21 trillion and counting, and then there's the Fed. Inconclusive Fed makes it pretty confusing as to what kind of data we root for. Is good news going to be good news from here on out, or do we root for mediocre news? What are we looking for?
Well, you do root for something in between, and I think that he handled himself quite well yesterday. I think he was frank, he was open, he was flexible, and I'm not worried about how the Fed is going to act and react. I think they're going to be very measured, very deliberate. The trade issue is another issue. It could spin out of control. I'm hopeful that everybody's too smart to let it get out of control.
Go ahead.
Just one quick thing. I think another big disappointment for Wall Street today was the fact that the yield curve went down again. Look, financials make their money off of the spreads, not just the Fed rates. So if that keeps tightening, the financials just aren't going to be able to do as well.
Right. The financials got slaughtered today. I mean,
exactly.
Again,
yeah, absolutely.
What happened? I thought the financials, if you're going to have potentially 4 rate hikes, weren't they supposed to be the safe haven in today's session?
Not if the yield curve is dictating that it's going to slow the economy down. And then you had the Facebook pressure on top of that. So you had financials and tech under pressure today.
So spell it out a little bit more for our audience who may not understand the verbiage here a little bit. What is so ominous about the yield curve and what's happening with the yield curve right now?
And, Powell actually brought up the yield curve. He was asked about the yield curve, and he said that he was monitoring it. But the closer we get to short rates, the 2-year rate, coming together with the 10-year rate, the more danger the economy is at going into recession. It really has never failed to predict the recession, you don't want to see short rates above long rates. The long rates, the more we see long rates come down, the more that the economy is beginning to factor in recession probability.
And there's no reason for a bank to lend for more than a short-term rate. So there's no reason to give you a 30-year mortgage if they're not going to make any more money off of taking all that extra risk on a 30-year versus a 2-year.
Well, and what also makes this more complicated is we're starting to get cracks in the junk bond market, and credit spreads were widening, and people were starting to worry about if you have rising rates and perhaps a slowing economy, what does it do to lower quality companies?
But how can all of these things coexist? Enough evidence, whether you want to call it soft data, hard data, whether it's surveys, whether it's the jobs report, this earnings season that was absolutely magnificent, the Fed increasing their own guide outlook. How can that exist in a potential recessionary, with a recession right around the corner?
Well, to me, I think the bottom line is that the market is starting to look at earnings, and they're starting to sniff out inflation, which will keep the Fed in a hiking mode. I'm not sure if you saw General Mills. They reported today that input costs are crushing their margins. We will hear more of that with the next earnings season, and you hear it all over the industrial complex that input raw materials prices are really hurting people. Right. They're going to have to pass those price increases along, which is going to push up consumer prices, or margins are going to compress. One or the other.
One thing that we also see with these markets is anytime there's a whiff of a potential so-called, quote, constitutional crisis, the market acts adversely. You know, the change in with respect to President Trump's legal team, Jim.
Yeah.
Just how concerned should we be with that? Because that's an issue that doesn't go away in Washington.
Right, and it's been creeping into the market on an incremental basis, reflecting itself in more uncertainty and perhaps a compression of multiples, because we don't need a constitutional crisis. This weekend is apparently going to be a big weekend in terms of interviewing some of the people who are hostile to Trump, and then you have to watch how the Republicans react to that news. So it's not good. All other things being equal, it would be much better if we had more stability in Washington.
In the meantime, it looks like we're going to avert a potential government shutdown. That's always fun stuff. But all of these things, Erin, which one right now carries the most weight with you?
For me, I think what's moving the markets the most right now is the threat of a trade war. And, you know, we've talked about this before. It's definitely concerning that they're using just the stick versus a carrot and a stick. I'm in complete agreement that we should address China stealing the IP. There's, you know, estimates of $600 billion a year being stolen. It's just that how you go about attacking that problem, it really feels like this is one of the worst possible scenarios.
Yesterday, Powell didn't want to get dragged into this whole pull, because that's what happened when he went to his Humphrey Hawkins, right? Both sides of the aisle, they tried to use him and push him for the agenda. But despite the fact that he says this whole tariff thing won't change their outlook, in reality it would, wouldn't it?
Oh, if it goes a step beyond tariffs, I think China was actually pleased with just being slapped on the wrist with steel tariffs and aluminum tariffs. But if it turns into a full-blown trade war, and he said this, then it will become problematic. He referred to colleagues around the table who raised concerns about the tariffs.
Well, they spoke to businesses who raised concerns.
Yes. But if it becomes a trade war, and the way and the aggressiveness of this, taking the 301, it's very, very aggressive. Markets should be spooked.
And Fed will react. All right. Thank you all very, very much. Appreciate it.